Joining me now, James McDonald is the CEO of Hercules Investments, and Bryce Doty is Senior Portfolio Manager at CIT Investment Associates. Welcome, guys. And James, I'll start with you. I know there are a lot of tech themes that you like, but would you say that the pullback in the big cap tech names right now is telling us something more broadly about the market?
It's important to understand context and where we're coming from. August had a 30.32 average PE ratio in the S&P. And as we know, the S&P is dominated by tech. That was the highest average PE month in 20 years. And so there was incredible gains in August. And so we had to have a pullback. As significant as this pullback was, a technical correction, we're still higher than we ended July. The momentum is still there. However, I do think there's continued downside given the macro environment with COVID. And we see overall general economic weakness in our country. And so we're going to have some tepid growth. But when we have a big pullback, we're going to go in and buy.
James, it's interesting that you say you see more downside for tech, but because of weakness in the macro environment and problems with COVID, a lot of people are thinking that it's actually because of the economic rebound that we're seeing the weakness, because people are finally rotating into Caterpillar and 3M and some of these other names. They say I can find growth elsewhere than just Facebook and Google. What would you say to that?
Well, let's put our thinking caps on and look at, where the money is coming from and how it's being spent and how it's being applied. What happens to retail sales when supplementary unemployment benefits run out? What happens at that point? What happens when the trickle-down effect of all these sub-industries shutting down and the momentum of our great bull market of 12 years from 09, when that starts to slow down, and the Fed, where the smartest people in the world, economically speaking, are saying that we're not going to do anything for 38 months. To quote Powell, they're going to hold rates until the end of 2023 at the earliest. That's 38 months of uncertainty. As far as back as I can check, we haven't seen anything like that. With that overhang, there's going to be ramifications from what we've seen in this instant recovery that we saw. It's temporary. As we see in all big market sell-offs, there's a bounce, but this bounce has stopped. We're not going straight up anymore.
Okay.
And as we come down, we're going to see that across the sectors.
And I know
tech.
all of that is why you like some of the secular growth stories like Datadog, like Zoom, like DocuSign. Right. So, Bryce, let me turn to you, bring you into this conversation. Are you as cautious on the macro outlook and COVID and big tech as James?
Well, I think the timing of what he's talking about, what James is talking about, is kind of critical. But that's also what's creating the opportunity. In the near term, you're going to see some things take some hits with the virus spreading because of everyone going back to school and whatnot. But the vaccine trade is alive and well, and it's full on. I think that the rotation is actually going to gather steam. It's not that any tech company is in trouble. Okay, it has nothing to do with that. It's just you have to sell something to buy all the companies that you think are going to rebound as the vaccine gets rolled out over the next 6 to 9 months. So that the market's looking out past that. And in bonds that we're mostly focused on, it's definitely a time to go out there and buy some of these names that have really been out of favor. Some of the REITs, the airlines, the cyclicals, and things like that. But hedge yourself with some tips because the Fed is not going to stop inflation. And, you look at what's happened to inflation in the last 3 months. If it continued for 12 months, the CPI would be over 5%. So you need to kind of take that into account. And I think the market's confused by that. So you'll see a lot of volatility as investors try and figure out what is Fed policy.
But Bryce, as you know better than anyone, being a fixed income guy, the market is not extrapolating this recent CPI trend into the future. The 10-year is sitting at barely 0.2% and just doesn't think it's going to be sticky. The Fed itself yesterday said that basically doesn't believe it's going to get to 2% or above inflation for the foreseeable future, despite that now being its mandate. So, I know you're saying just own tips as a hedge, and in that case, it's not the base case. But tell me about some of the other parts that you think are more attractive for investors. You mentioned REITs and airlines and cyclicals. Is there still value there on the fixed income side? And what about the potential losses there?
There are. So it's a minefield, especially in high yield. I'm just starting to warm up to high yield again, but with bankruptcies running at a record pace, it's really hard to like high yield very much. But in investment grade, you look at certain companies, the amount of money that, let's say, Delta or some of the other airlines been able to raise is going to be enough for them to be sustained throughout the downturn. So high quality investment grade type names, I think, are still there in the cyclical area that you want to be in. Now, REITs, it's again a minefield. Stay away from office REITs, but any REITs that have, well, they all have certain kinds of leverage. If the Fed is going to keep rates super low, their borrowing costs are going to be super low. So you can get a storage REIT or a residential apartment REIT, that's not quite, it still has a little hair on it. Okay, it's not risk free, but you can still get some income.
Yeah,
we like those types of ideas.
Got to have a little hair on it in order to get any return these days. And we're going to be talking about warehouses a little later on. We'll leave it there for now, guys. Thank you both. Bryce Doty of CIT Investments, James McDonald of Hercules Investments. Some different views about where this market is headed.